Imagine a company based out in Clayton, Missouri, founded way back in 1892.
Right, so practically ancient by corporate standards.
Oh, totally. And on paper, they make things like industrial pool chemicals and shotgun shells.
Yeah, which sounds like this dusty legacy manufacturing business that the modern tech economy just completely left behind, you know?
Exactly. To the untrained eye, it sounds incredibly boring. But if you know how to read their financial data, you realize that this company is actually sitting on a geopolitical goldmine.
It's insane. Right now, a conflict halfway across the world, combined with this historic shortage of shipping vessels, has accidentally turned the U.S. Gulf Coast into an unassailable economic fortress.
Yeah, and this 130-year-old company is just sitting right behind the walls, basically printing cash.
It completely flips our understanding of modern economics. I mean, for the last 40 years, the dogma has been that globalization makes everything cheaper, right?
Right, the geography doesn't matter anymore.
Exactly. But when you dig into the operational data from a company like this, you see the exact opposite. Geography is suddenly the only thing that matters.
And that brings us to the mission for today's deep dive. We are taking the Olin Corporation's Q1 2026 earnings call dated May 8th, 2026, and we are tearing it apart to see how the global economy is actually functioning right now.
Because this isn't just some dry document of balance sheets and corporate jargon.
No, not at all. If you know how to read the matrix code here, the transcript of this single hour-long call is effectively a real-time geopolitical thriller.
It really is. It shows us exactly how, sticky inflation, broken supply chains, and international conflicts are just completely rewiring global manufacturing.
And for anyone holding the stock or just trying to understand the market, the overarching narrative here is the death of borderless manufacturing.
Yeah, and the sudden incredible value of local advantage. Olin operates across three massive segments. You've got chlor-alkali products and vinyls, which they call CAPV.
Right.
Then their epoxy division, and finally, Winchester Ammunition.
Yeah. And if you look closely at how management is navigating these three totally distinct markets, you realize they're executing a masterclass in exploiting structural regional advantages.
Oh, absolutely.
Let's start by defining that structural advantage because Olin obviously doesn't operate in a vacuum. To understand why their chemicals are suddenly so valuable, we really have to look at the macroeconomic environment they're swimming in.
You have to look at the big picture, yeah.
Right. So we are seeing major disruptions stemming from the ongoing conflict involving Iran, purely from a supply chain and energy perspective. How is that conflict rewriting the rules for chemical manufacturers?
Well, it all comes down to the fundamental feedstocks of the chemical industry. Mm-hmm. Chemicals aren't just made from thin air, right? They're made from hydrocarbons.
Right, oil and gas.
Exactly. In Europe and Asia, the chemical industry is largely built on a petroleum derivative called naphtha, and that is derived directly from crude oil. So their base cost of manufacturing is intimately tied to the global price of Brent crude. But in the United States, however, the chemical industry is built on natural gas liquids, things like ethane and propane.
Which are extracted alongside natural gas.
You got it.
So you basically have two different continents running their factories on two completely different fuel systems.
Precisely. And Olin CEO, Ken Lane, pointed out the massive disparity this creates right now. Because of the geopolitical instability in the Middle East, Brent crude oil is sitting at over $100 a barrel.
Wow.
Yeah. So it is incredibly expensive to run a naphtha-based chemical plant in Asia or Europe today. But in the U.S., thanks to our domestic shale production and our insulated pipeline infrastructure, natural gas is trading at a mere $2.70 to $2.80.
That is a staggering gap. I mean, if I'm Olin, sitting safely on the U.S. Gulf Coast down in Freeport, Texas, I'm pulling cheap natural gas out of my own backyard.
Yep.
While my European and Asian competitors are paying a massive premium for imported crude oil just to turn their lights on.
And that energy spread creates an immense structural moat. But it gets even more complicated when you look at the Asian market specifically.
Oh, right. The sanctioned oil thing.
Yes. During the Q&A portion of the earnings call, there was this fascinating exchange about the curtailment of sanctioned oil.
Break that down for us.
So for years, there's been a massive shadow fleet of oil tankers moving heavily discounted, sanctioned crude around the Asian markets.
We're talking about oil that is basically sold off the books, right?
Exactly. Often transferred ship to ship in the middle of the ocean just to obscure where it came from.
So Asian chemical producers were quietly buying this black market crude at a steep discount, which artificially suppressed their production costs.
Yes, it made them look vastly more competitive on the global market than they actually were.
But the recent escalations and tighter enforcement have severely curtailed that flow of shadow oil, right?
Exactly. Suddenly, those Asian competitors are being forced out of the shadows and into the open market, where they have to pay that $100 plus premium for Brent crude.
So their production costs didn't just tick up, they skyrocketed virtually overnight.
Just exploded.
Okay, I understand the energy disparity, but let me challenge this from a logistics perspective. Let's say an Asian producer is suddenly facing high costs. Historically, global supply chains are incredibly efficient at arbitraging those gaps.
You're in a normal world.
Right. So if costs spike in Asia, why couldn't a producer in the Middle East or even South America just ramp up production and flood the global market with cheaper product, basically undercutting Olin's pricing power? Why doesn't that happen anymore?
Well, that is the exact question an analyst would have asked 5 years ago, assuming the oceans act as a frictionless highway for trade.
But they don't anymore.
No. Ken Lane explicitly addressed this on the call. He pointed out that freight rates have absolutely exploded. We're seeing historic disruptions in major shipping lanes, like the Red Sea reroutings, which forced ships to take massive detours around the Cape of Good Hope.
Which burns more fuel, takes weeks longer, and just completely ties up the global fleet, right?
Yes. Ships are entirely out of position globally. You cannot simply put bulk industrial chemicals on a vessel in Asia and ship them to the U.S. West Coast.
Or load up a tanker in Europe and send it to the East Coast.
Right, because the exorbitant cost of that boat ride instantly erases any underlying price advantage the manufacturer might have had. The math simply breaks.
The friction of the ocean essentially acts as a tariff. The water itself is protecting Olin.
It creates a phenomenon that industry insiders are calling a security premium.
A security premium? I like that.
Yeah. If you are a U.S. manufacturer making PVC pipes for housing, or a municipality treating drinking water, you cannot risk your chemical supply chain being held up by a geopolitical conflict or a sudden spike in maritime insurance.
You need that product on time every time.
Exactly. Buyers are now perfectly willing to pay Olin a massive premium simply for the guarantee that the chemicals are originating from Texas via a rail car, rather than navigating a contested ocean on a cargo ship.
So local supply is suddenly perceived as a critical risk management tool.
Totally.
Well, that perfectly sets up the reality of their biggest moneymaker, the chlor-alkali products and vinyl segment CAPV. Olin isn't just passively sitting behind this geographical moat, they are aggressively weaponizing it.
They really are.
Let's dig into the chemistry and the operations of this division. What exactly is an ECU?
ECU stands for electrochemical unit. So the fundamental metric used to measure production in this industry.
Okay, so how does it work?
The manufacturing process here is essentially taking brine, which is heavy salt water, and running a massive electrical current through it.
Just shocking salt water.
Basically, yeah. This process of electrolysis breaks apart the salt and the water molecules. But the chemical reality is that you cannot produce just one thing. The reaction always yields a rigid fixed ratio of chlorine and caustic soda, along with some hydrogen gas.
So you literally cannot make one without making the other. If you want chlorine, you are going to end up with a pile of caustic soda.
Right. So managing the CAPV business is an incredibly complex balancing act. You have to constantly find end markets for both sides of that chemical seesaw.
And if demand for chlorine spikes, but nobody wants caustic soda.
Then you run out of storage tanks for the caustic soda, and you have to shut down the plant, even though people are begging for chlorine.
Wow, okay. And the earnings call noted that merchant chlorine demand started to see a seasonal uptick in mid-March, which makes sense.
Yeah, totally expected.
As the weather warms up in the U.S., municipalities start treating swimming pools and drinking water, and the agricultural sector starts demanding crop protection chemicals, which rely heavily on chlorine.
Yep.
But the main event in Q1 wasn't the chlorine, it was the caustic soda side of the equation.
Oh, absolutely. The global market for caustic soda is currently experiencing a severe shock.
Because of the Asian producers.
Exactly. Going back to those Asian producers who are suddenly cut off from cheap sanctioned oil and facing astronomical crude prices, they just couldn't absorb the costs. Several major Asian vinyls producers were forced to declare force majeure.
And for anyone outside the legal or manufacturing world, declaring force majeure means a company is invoking an act of God or extreme circumstance clause in their contracts,
Right.
stating that it's physically or economically impossible to fulfill their obligations. They basically throw their hands up and shut the machines off.
And a chemical plant is not a light switch.
Yeah.
Shutting it down and restarting it is a massive capital-intensive undertaking.
So how much supply actually came offline?
The CEO provided a truly staggering number on the call. Because of these Asian shutdowns, an estimated 6 to 9% of the entire global vinyls capacity is currently offline.
Wait, 6 to 9%? 6 to 9% of the world's supply simply vanishing is catastrophic for buyers. And going back to the chemical seesaw, if those plants aren't making vinyls, which consume chlorine, they also aren't producing the byproduct, caustic soda.
Exactly. The global supply of caustic soda absolutely plummeted while global demand remained relatively stable.
And Olin pounced on that.
They sure did. Olin saw this dynamic unfolding and executed incredibly aggressive pricing actions. They pushed a domestic price increase for caustic soda of $185 per ton just in the first half of the year.
$185 a ton is an astronomical hike for a bulk industrial chemical.
Massive.
During the Q&A, analysts were questioning if that was even sustainable. I mean, normally when you hike prices that aggressively, you essentially send an invitation to every competitor in the world to undercut you.
But Ken Lane's response was completely grounded in that new global reality we discussed. He told the analysts that cheap product from Europe or Asia simply isn't crossing the oceans to discipline the U.S. market anymore.
The supply chain has structurally changed.
Right. Olin believes this high pricing environment is sticky because the underlying driver, the exorbitant cost of energy and freight for their international competitors, is not going away anytime soon.
So they are printing money on the macro environment, but let's look at their actual execution on the ground, specifically at their massive integrated facility in Freeport, Texas.
Yeah, Freeport is a beast.
The call detailed a mix of impressive operational successes and a rather glaring failure. Let's start with the success. They completed a triennial turnaround of their VCM assets. What is VCM and why is a turnaround such a big deal?
So VCM stands for vinyl chloride monomer. It is a highly reactive, hazardous chemical intermediate used to make PVC plastics.
And you can't just run it forever?
Definitely not. You don't just run a VCM plant until it breaks. Every few years, in this case, triennially, you have to execute a planned turnaround.
Which means what, exactly?
You take the entire facility offline, purge the volatile chemicals, open the massive pressure vessels, inspect for corrosion, replace spent catalysts, and upgrade the piping.
Sounds like a logistical nightmare.
It involves thousands of specialized outside contractors descending on the site for weeks. It is incredibly expensive and notoriously difficult to keep on schedule.
But Olin managed to complete this VCM turnaround early and on budget, which is a major win.
Huge win.
But then the CEO had to address an unplanned vinyls outage at that exact same Freeport facility.
Yeah, that was the bad news.
And this is where I struggle to give them a pass. If global prices are spiking to historic highs because of an international supply shock, having your own machinery break down unannounced feels like a colossal failure of maintenance.
It's definitely not ideal.
You are missing out on the most lucrative pricing environment of the decade.
The analysts certainly didn't let them off the hook for it, and management didn't try to hide the pain. An unplanned outage during a massive price spike is the ultimate nightmare for a plant manager.
I can only imagine.
But the key takeaway from the transcript, however, is the velocity of their response. Management didn't just apologize. They immediately initiated a formal root cause analysis to identify the exact mechanical or systemic failure that caused the trip.
And did they give a timeline for the fix?
They did. More importantly, Ken Lane committed on the call to having those assets restarted, quote, late next week.
So they understand they're racing the clock. Every hour that plant sits idle, they are burning through potential high-margin revenue. They have to fix the pipe while it's raining gold.
It is a perfect encapsulation of the CAPV segment right now. It's a highly lucrative, structurally advantaged business, but it requires flawless, intense operational execution to actually capture the windfall.
Well, while CAPV is cashing in on this geopolitical moat, that exact same global chaos is forcing Olin to make some incredibly painful choices in their other divisions.
Yeah, geography doesn't save everyone.
Right. You can't just rely on geography everywhere. Look at their epoxy business. This part of the transcript reads less like a victory lap and more like a corporate survival story.
Because the global epoxy market has been fundamentally broken for the last few years. Unlike the U.S. Gulf Coast advantage in basic chemicals, the epoxy market has been flooded by heavily subsidized Asian supply.
Let's define what that subsidy actually looks like. It's not necessarily a government writing a check directly to a factory, right?
No, usually it takes the form of state-owned enterprises providing raw materials at below market costs or giving preferential energy rates.
Or state-backed loans that don't require normal commercial return.
Exactly. This allows foreign producers to churn out epoxy resin and dump it onto the global market at prices that are mathematically impossible for a purely commercial Western company to match.
It created a race to the bottom.
And Olin's epoxy division was bleeding cash because of it.
But in this Q1 2026 call, they announced a major milestone. The epoxy business has officially returned to profitability. They are back in the black.
A huge turnaround.
So how do you beat a competitor whose underlying costs are subsidized by a nation state?
You execute what the industry calls a shrink-to-grow strategy. Olin had to take a brutal look at their global footprint and amputate the limbs that couldn't be saved.
Like Brazil?
Exactly. They made the permanent decision to close their manufacturing plant in Guarujá, Brazil.
So they are essentially taking the pain up front. By shutting down Brazil, they stopped the cash bleed of operating an uncompetitive asset. But how does closing a plant in South America actually change the math for their core operations in Europe and North America?
It changes the math because it forces regional consolidation and allows them to restructure their supply chain. They didn't just close Brazil, they executed severe regional rationalizations across Europe as well.
Shrinking the footprint.
Right. They right-sized their European footprint to align with the new, lower demand reality of the continent. And the financial impact is stark.
What were the numbers?
They noted that this new European cost structure is on track to deliver $40 to $50 million in hard annual cost improvements.
$50 million a year just from trimming the fat and walking away from unwinnable markets. But, you can't save a business purely through cuts. Eventually, you have to find a way to sell the product for more than it costs to make. What is their strategy on pricing, given that the subsidized Asian product is still out there?
Well, they decided to test the limits of their remaining market power. In March and April, Olin pushed through jaw-dropping price hikes.
How big?
They raised their epoxy resin prices by $1,200 per ton in North America and 1,300 euros per metric ton in Europe.
$1,200 a ton. If I am a European manufacturer buying epoxy, how on earth do I accept a $1,200 price hike when I know there is cheaper Asian products sitting on a boat somewhere?
Because Olin engineered a situation where the customer has no other choice. During the call, Ken Lane specifically praised his team for maneuvering Olin into the position of being the last integrated epoxy producer in Europe.
Okay, let's break down that word integrated. It doesn't just mean they make epoxy. It means they control the entire chemical recipe from start to finish rather than buying the ingredients on the open market, right?
Exactly. An integrated producer manufactures their own raw feedstocks, the chlorine, the bisphenol, the epichlorohydrin, and funnels them directly into their own epoxy reactors.
And non-integrated competitors.
They have to buy those ingredients on the spot market, which exposes them to massive volatility. Olin basically played a corporate game of survivor. They used their balance sheet to weather the storm, while the non-integrated European competitors bled out and shut down. Now, Olin is the last local producer standing.
So they traded overall market share for absolute pricing power.
Bingo.
Because if a European customer is building wind turbine blades or advanced aerospace components, they can't risk their assembly line shutting down because a ship full of cheap Asian epoxy gets delayed by Houthi attacks in the Red Sea.
They can't risk it.
They are forced to pay Olin's $1,200 premium just to guarantee the product arrives on time from a local factory.
It is the ultimate manifestation of the security premium. But Olin is also shifting what they sell. The transcript highlights a strategic pivot away from basic commodity resins and toward formulated solutions.
Right, they are moving up the value chain. Wow. It's the difference between selling raw silicon wafers by the pound versus selling the highly engineered microchips printed on them.
That's a great analogy.
You move from a pricing model based purely on weight and volume to a pricing model based on performance and intellectual property.
Exactly. They are focusing on highly specialized epoxies tailored for electronics, semiconductors, and power generation infrastructure.
Stuff that absolutely cannot fail.
Right. These are markets where the epoxy might only represent a tiny fraction of the overall cost of the final product, but a failure of that epoxy would be catastrophic.
So in those applications, the customer is completely inelastic to price. They just want the highest quality and the most reliable supply.
Exactly.
It is incredible to see a company leverage integration to essentially trap their European customers into paying a premium. But that dynamic assumes Olin controls the upstream raw materials.
True.
What happens when the shoe is on the other foot? What happens when Olin is at the mercy of global raw material spikes that they don't control?
And that brings us to their third major segment.
Winchester Ammunition.
Right. Winchester is a fascinating pivot because it moves us out of heavy industrial chemicals and into a legacy consumer and military brand.
It's a completely different beast.
To understand the current state of Winchester, the CEO had to walk the analysts through the perfect storm that battered the division over the previous year.
Anyone who has tried to buy sporting ammunition over the last 5 years knows exactly how volatile this market has been. It has been a textbook example of the bullwhip effect.
The bullwhip effect is exactly right. In 2020 through 2022, there was unprecedented panic-driven consumer demand for firearms and ammunition.
Shelves were empty everywhere.
Retailers couldn't keep boxes on the shelves, so they massively overordered from manufacturers like Winchester, building up massive stockpiles in their backrooms. But eventually, the consumer panic subsided.
And suddenly, the sporting goods store manager realizes they have 2 years' worth of inventory sitting in the warehouse while daily sales have flatlined.
Yep.
They immediately stop ordering from Winchester.
Which leaves Winchester choking on excess production. That inventory glut defined their miserable 2025.
But they're turning a corner now.
They are. The positive inflection point in this earnings call is that the pipeline has finally cleared. Olin took decisive action late last year to throttle back production and let those retail inventories rebalance.
Okay.
Now, in early 2026, they're reporting that retail shipments from the factory are finally perfectly aligned with out-the-door consumer sales at the cash register.
The backlog is gone. The flow is normalized. And because of that, management is projecting a commercial volume uplift in the mid to high single digits year over year.
It's a solid rebound.
And they also noted expectations for higher military contract sales in the second quarter, which provides a fantastic, stable baseline of volume. But let's talk about the cost of goods sold, because volume doesn't mean profit if your raw materials are crushing you.
And this is the major headwind the CEO highlighted. Ammunition requires highly specific metals, primarily copper and brass, along with specialized chemical propellants.
And if you look at the global commodity markets, copper is currently experiencing a massive supercycle.
It really is, which is driven entirely by macro forces outside of Winchester's control. The global transition to electric vehicles, the upgrading of electrical grids for renewable energy, the expansion of AI data centers.
All of these require unimaginable amounts of copper.
Exactly. Winchester is suddenly competing for raw materials against the largest tech and automotive companies on Earth.
So copper prices are through the roof. The natural question is, how can Winchester possibly maintain their margins when the core metal in their product is at historic highs?
You would think it would obliterate their profitability. But this is where the sheer gravity of a legacy brand name comes into play.
Brand power.
Yes. The management team explained the lag effect of their pricing strategy. When raw copper spikes, it takes Winchester a quarter or two to negotiate new pricing contracts with major retailers like Bass Pro Shops or Walmart.
But the critical point is that they can negotiate those hikes.
Exactly. Management explicitly stated that once this current round of pricing actions is fully implemented across the retail channel, they expect the higher prices to offset the vast majority of that severe material cost inflation.
Wow. They are passing the entire multi-million-dollar bill for the global copper shortage directly to the guy buying a box of shells for hunting season.
Pretty much.
And they are supremely confident that the customer will pay it without blinking simply because it says Winchester on the box. That is the definition of unassailable brand power.
It proves that Winchester isn't just a commodity metal bender. When you have brand loyalty that strong, you can dictate terms to the market even when your own supply chain is under duress.
All right, so we have explored the geopolitical moat of CAPV, the brutal survival and integration strategy of epoxy, and the pricing power of Winchester.
The three pillars.
But all of these distinct operational narratives eventually filter down into one centralized place: the corporate balance sheet. In this next section, we need to unpack the playbook of Olin's CFO, Todd Slater. How are they managing the actual flow of capital behind the scenes?
Slater's portion of the call was a masterclass in defensive financial structuring. I mean, in a volatile macroeconomic environment, cash and flexibility are the only things that keep a company alive.
True.
Slater highlighted a proactive move they made in February to amend their bank credit facilities. They renegotiated the terms of their debt to ensure they have massive covenant flexibility all the way through late 2027.
Let's expand on that concept of covenant flexibility. When a syndicate of banks lends a corporation $1 billion, they don't just hand over the check and walk away.
Oh, no.
They embed strict financial rules into the contract known as covenants. The most common is a leverage ratio, stipulating that the company's total debt cannot exceed a certain multiple of their annual earnings.
Exactly. And if a company breaks that ratio, even by a fraction of a percent for a single quarter, it triggers a technical default.
Which means
the banks can theoretically demand immediate repayment of the entire principal, which would instantly bankrupt the company.
So by going to the banks early and amending these facilities, Olin essentially got the lenders to loosen those rules and widen the goalposts,
Right.
which is incredibly smart. You buy the insurance policy before the house catches fire. It gives Olin the breathing room to know that if earnings dip temporarily, say because of an unplanned outage at a vinyls plant.
Which just happened.
Exactly. They aren't going to accidentally trigger a massive cascading debt crisis.
And because of that proactive management, they boast $1.3 billion in available liquidity. And importantly, they noted they have 0 major bond maturities coming due before 2029.
Wow.
Yeah, they have a massive runway before they have to worry about refinancing or paying back large chunks of their debt in this high interest rate environment.
That being said, they do carry a significant amount of debt. The CFO stated their target is to keep their leverage ratio below 2 times their earnings across the business cycle.
Which is healthy.
But he also transparently admitted they expect to end 2026 with a leverage ratio just above 4 times. 4 times leverage is double their target. That sounds like a glaring red flag for a cyclical chemical company.
It would be a massive red flag, except Slater clearly articulated the mechanics behind it. The spike in leverage isn't driven by a collapse in operational cash flow.
What's driving it then?
It's driven by large scheduled cash payments occurring in the first half of 2026 to resolve legacy litigation matters.
They are essentially taking a one-time massive hit to clear the legal decks for the future.
Exactly.
It artificially inflates their leverage ratio in the short term, but it permanently removes an overhang of uncertainty from the stock. I can respect that strategy.
It makes sense.
But speaking of the balance sheet, there was a detail buried in the tax section of the call that completely blew my mind.
You are referring to the impact of the Inflation Reduction Act.
Yes.
Slater highlighted an absolute financial windfall, noting that 2026 will essentially be a cash-free tax year for Olin.
Wait, a cash-free tax year?
Give or take $20 million, a multi-billion-dollar industrial manufacturer is effectively going to owe 0 in net cash taxes to the federal government this year.
How does the math on that possibly work?
It ties back directly to the chemistry we discussed earlier. Remember the ECU process?
The salt water and electricity thing.
Right. When you run electricity through salt water to make chlorine and caustic soda, the chemical reaction forcefully separates the hydrogen atoms from the water molecules, releasing pure hydrogen gas as a byproduct.
And historically, chemical plants just burned that hydrogen for basic fuel or vented it.
Exactly. But the 2022 Inflation Reduction Act completely changed the value of hydrogen. Specifically, Section 45V of the Act offers massive production tax credits for clean hydrogen.
Oh, I see where this is going.
Because Olin's hydrogen is generated as a byproduct of electrolysis, rather than through traditional, highly pollutive steam methane reforming, it qualifies for these massive government credits.
That is wild.
Olin expects to receive such large refunds from prior years related to these Section 45 credits that it completely wipes out their current operational tax burden.
They are quite literally getting paid by the federal government for a chemical reaction that they have been doing for decades anyway.
It is the ultimate localized structural advantage.
That is free cash flow dropping straight to the bottom line. But a company can't just rely on tax loopholes and macro environments. Let's look at what they are actively doing to control their own operational costs.
Right, the stuff they can actually control.
The CFO spent a lot of time hyping up an initiative they call Beyond 250.
Beyond 250 is their structural cost reduction program. The stated goal is to permanently remove $250 million in cumulative structural savings from the company's operating budget by 2028.
And did they bring receipts?
They brought receipts to the call. They delivered $44 million in hard savings last year, and they were projecting another $100 to $120 million in savings this year.
Wait, $250 million in cumulative savings sounds great on a slide deck, but I have seen a dozen of these Beyond X initiatives at other legacy companies.
Usually just buzzwords.
Exactly. Usually they end up being nothing more than spreadsheet theater, slashing the travel budget, freezing hiring, and quietly laying off middle management. What makes this an actual structural change to the business rather than just a temporary trimming of the fat?
The CFO anticipated that exact skepticism. He explicitly stated this is not about trimming around the edges. This is a fundamental physical rewiring of how their massive industrial plants operate.
Did he give examples?
They gave 3 specific, highly technical examples to prove this is real. First, they have nearly doubled their time on tools at the Freeport facility.
What exactly does time on tools measure in a chemical plant?
It measures the true efficiency of the maintenance workforce. A chemical plant like Freeport is the size of a small city. Historically, if a union pipe fitter clocks in for a 10-hour shift, they might spend 2 hours securing hazardous work permits, an hour walking across the facility.
Oh, wow.
2 hours waiting for scaffolding to be erected by a different contractor, and an hour tracking down the right specialized valve. Out of a 10-hour shift, they might only spend 3 hours actually holding a wrench and fixing the pipe.
That is incredibly inefficient.
Right. So by reorganizing their digital workflows, staging materials closer to the work sites, and streamlining their permitting processes, Olin has doubled the actual productive wrench-turning time of their workforce.
They are essentially getting twice the mechanical output for the exact same payroll cost.
Yes. The second structural change is the implementation of AI tools to shift their maintenance culture from reactive to proactive.
Okay, AI in a chemical plant. How does that work?
In the past, you ran a massive industrial pump until it broke. When it fails catastrophically, it causes dangerous conditions, unscheduled downtime, and costs a fortune to replace.
So how does the AI change that?
They are installing advanced acoustic and vibration sensors on their critical equipment. These sensors feed real-time data into an AI model that listens for microfractures in a bearing or microscopic changes in heat signatures long before the human ear or eye could ever detect a problem.
That's pretty cool.
The AI predicts the failure based on historical risk models, allowing Olin to schedule a cheap preventative bearing replacement during a planned downtime window, entirely avoiding the catastrophic pump failure.
It's the industrial equivalent of an algorithm telling you to replace your car's timing belt based on microscopic wear patterns, rather than waiting for it to snap on the highway at 70 miles an hour and destroy your engine block.
Precisely. And the third metric Slater provided brings it all together. Through these efficiencies, they have achieved a 15% reduction in overall site headcount, while simultaneously reducing their reliance on expensive third-party outside contractors.
And they did all of this while actually improving the overall mechanical reliability of the plant.
Yep.
When you break down the physical realities of doubling time on tools, utilizing acoustic AI predictive maintenance, and structurally reducing the contractor footprint, it becomes very clear that this is not a PR stunt.
Not at all.
They are fundamentally changing the physics of how their factories operate, and that drops tens of millions of dollars straight to the bottom line every single year.
So we have the geopolitical moat of the U.S. Gulf Coast, the massive pricing power in epoxy in Winchester, the IRA tax windfall, and this hardcore factory efficiency.
Which is a phenomenal setup. But now we need to bring all of these threads together to understand the long game. What does management see on the immediate horizon, and how are they positioning for the next decade?
Let's start with the immediate horizon, specifically their guidance for the second quarter of 2026.
And numbers.
The numbers they put out represent a massive sequential leap in profitability. In Q1, they delivered roughly $86 million in adjusted EBITDA, which is effectively their pure operational cash profit.
Right.
But for Q2, they are guiding to an expected range of $160 to $200 million.
That is a midpoint of $180 million. They're guiding to more than double their operational earnings in the span of 3 months.
Yes.
Doubling earnings quarter over quarter for a massive industrial company is practically unheard of.
Right.
You could feel the shockwaves through the analyst Q&A.
Oh, they were stunned.
Multiple Wall Street analysts kept trying to pin the CEO down, essentially asking, is this the top? Does this $180 million run rate represent the new mid-cycle peak for Olin?
And Ken Lane's response to that question is arguably the most aggressively bullish statement in the entire transcript. He firmly pushed back on the analysts, stating unequivocally that Olin is nowhere near normalized mid-cycle earnings.
He literally said they aren't even mid-cycle yet.
Exactly. This massive Q2 leap is not the peak. It is just the beginning of the ramp.
But how is that mathematically possible? I mean, if they are already capitalizing on historic supply shocks and pushing massive $185 per ton price hikes in caustic soda, where's the remaining upside supposed to come from?
The remaining upside comes from the fact that their core end markets are currently in a severe recession.
Wait, what?
Yeah. The CEO explained that Olin is achieving these phenomenal Q2 numbers despite operating in a heavily depressed macroeconomic environment. Look at the global housing and construction market.
Right, interest rates.
Because of sustained high interest rates, builders have been sitting on the sidelines. Olin hasn't seen a true recovery in housing, infrastructure, or general construction in the U.S. or Europe in years.
And housing is the ultimate demand engine for chemicals. You need PVC pipes for plumbing, vinyl siding for the exterior, chemical insulation for the electrical wiring, epoxy resins for the flooring.
Exactly. Olin is currently doubling their earnings without the single largest driver of global chemical demand even participating in the market.
So when central banks eventually ease interest rates and the suppressed demand for global construction is unleashed, it is going to act like rocket fuel on Olin's volume.
Rocket fuel. And to make that setup even more explosive, the CEO highlighted a major structural reality of the global chemical industry.
What's that?
There is virtually no new global capacity coming online before 2030.
Wow, none.
Because building a new multi-billion-dollar chemical facility takes years of capital expenditure, permitting, and construction. The industry underinvested during the volatile 2020s.
So when that massive wave of housing demand finally hits in 2027 or 2028, Olin will be one of the few producers standing there with available capacity, and there will be no new competitors entering the market to dilute their pricing power.
The theoretical upside is massive.
But relying purely on the spot market to eventually catch a housing boom is a risky game. Macro environments shift. Geopolitical tensions could ease, the Red Sea could open back up, and freight rates could plummet.
Right. If the oceans become a frictionless highway again, Olin loses that security premium.
Is management doing anything to lock in this current advantage for the long term?
They are acutely aware of that risk. Management spoke at length about the need to balance their portfolio to ensure optionality. They want to keep a portion of their capacity exposed to the daily spot market so they can capitalize on those sudden massive price spikes when supply chains break.
Makes sense.
But simultaneously, they are aggressively securing long-term strategic partnerships to build a permanent floor under their earnings.
Like the Braskem deal.
They highlighted their existing partnership with Braskem in Brazil for vinyls, which has been highly successful. But the major reveal in this call was a newly announced long-term agreement with Chemours.
Tell us about that deal.
This is a foundational deal. Starting in 2028, Olin will be the primary supplier of the core chemicals Chemours needs to produce titanium dioxide.
For those unfamiliar, titanium dioxide, or TiO2, is the essential white pigment used in virtually every paint, coating, and plastic on Earth. It is an absolutely massive, universally required product.
And by locking in a multi-year supply agreement with the industry leader in TiO2 starting in 2028, Olin is demonstrating incredible foresight.
They aren't just reacting to today's daily geopolitical crises or tomorrow's spot prices.
Right. They are leveraging their current position of unassailable strength to lock in guaranteed high-margin revenue years into the future.
It is brilliant strategic positioning.
Yeah.
So if we pull all the way back and synthesize everything we have extracted from the margins of this earnings call today, what is the ultimate narrative?
The narrative is that Olin is perfectly built to thrive in a fractured world. We are living through an era where global instability, localized wars, and the fragmentation of supply chains have completely dismantled the old world order of cheap, easy globalization.
Yeah, that era is over.
In this new, chaotic reality, Olin's deep integration, their U.S.-advantaged energy position, and their ruthless internal cost-cutting have transformed them from a legacy manufacturer into an absolute profit engine.
It fundamentally changes how you view the physical objects around you. The products that Olin makes are largely invisible to the consumer, but they form the literal backbone of modern existence.
Everything you touch.
The highly formulated epoxy resin stabilizing the microchip inside the smartphone you're using to listen to this right now. The chlorine that treated the municipal tap water you drank this morning. The vinyl siding protecting your home.
The ammunition carried by your local police department.
Every single piece of it is intimately tied to the geopolitical winds blowing through the Middle East, the shipping lanes of the Red Sea, and the natural gas fields of Texas.
That is the beauty of reading the raw financial code. Once you understand the underlying supply chains, you understand how the world actually functions, stripped of all the theoretical noise.
I am going to leave you with one final provocative thought to mull over on your own today. Based on everything we just unpacked regarding Olin's structural moats, the freight friction, the energy disparities, the security premiums, what if these temporary supply chain disruptions aren't temporary at all?
That's the scary thought.
If the chaos of the 2020s becomes the permanent new reality of global trade, will these regionalized supply chains eventually make locally advantaged companies completely unassailable monopolies within their home continents?
Are we officially witnessing the final irreversible end of truly globalized manufacturing and the dawn of fortress economies?
That is the multi-billion-dollar question that every CEO and policymaker on Earth is trying to answer right now.
It certainly is.
Thank you so much for joining us on this deep dive into the sources. We love taking these incredibly dense, complex financial documents and uncovering the massive, real-world stories hidden inside the data. Keep looking for the underlying mechanisms that drive our reality, and we will see you next time.